Before we begin with topic 3, I want to stop and do a quick summary of where we've been so far in the first two topics. In topic 1, we introduced the accounting profession. You did a bit of work on the accounting equation. We talked with vocabulary terms about things like the balance sheet, the income statement, assets, liabilities, owner's equity. We talked a little bit about what the accounting profession is like. In topic 2, we stopped and did some work with Excel. Hopefully you are familiar enough with Excel to use that spreadsheet program, and we'll be using that almost daily from now on. So if you had problems, difficulties with any of the problems in topic 2, you need to let me know because, as I said, I will assume that you know how to use that and how to download onto the problems onto your desktop, do the work, and then submit them to me. As we go through, again, I will remind you to take a look at the grades from time to time because if you have points taken off of a problem or an assignment, sometimes I'll make comments to explain why points were taken off. So you'll see that in the grades section. Okay, now we'll begin topic 3. Topic 3 is entitled Financial Statements, but before we get into those, something very important. If you look on your screen, you'll see at the top the accounting cycle, and we will be taking a look at this for just a few moments. This is kind of the basic situation that accountants face in businesses that are small, businesses that are large. So this will make up where we go from here through the rest of the course. If you look on your screen, you'll see that in the accounting cycle, this is the sequence of typically what happens. Businesses have transactions. Something takes place. Things are bought, things are sold. The business is running and hopefully making a profit, but transactions are kind of the basics of the day-to-day work. The accountant or the bookkeeper, if you look at this little section here, the term bookkeeper is often used in terms of the accounting profession. In a larger business, the bookkeeper is the person who does the day-to-day entering of the transactions into the records of the business. The accountant in a larger business deals more with interpreting the information and making recommendations to the owners. In a small business, this is typically one and the same person. The bookkeeper, the accountant is typically the same person. Again, in a small business, this may be the owner. He or she may be doing his or her own accounting work. So in that case, the terms are one and the same. We use the term accountant, but once in a while you run across the term bookkeeper, so keep that in mind. So the accountant or the bookkeeper records the transactions into the books of the business. And this is an important concept. There are two books that we will talk about in this course, the journal and the general ledger. Now I'm going to move down to the bottom of the page here. If you look at the bottom and you are familiar with Excel, you know there are various sheets. I'm on sheet 1, and if I click to sheet 2, I add a little information. So the information, first of all, is put into the journal. This is called journalizing, and we'll talk about that a lot later in the course. The next step, the information is taken from the first book of the business, the journal, and from there, the information is put into the second book called the general ledger. This is called posting. So we have something called journalizing that you'll need to know how to do, and you'll need to learn how to do what we call posting. So once a transaction happens, something is bought or something is sold, the bookkeeper or the accountant records this into the books of the business. This is the day-to-day work that happens all the time in a small business and in a large business as well. Information is put into the journal, called journalizing. Then that information is put into something called the general ledger, and we'll spend some time with that. Let's go down to the next sheet at the bottom of the page, and this is the next step in this accounting cycle. After the information goes from the journal to the ledger, at the end of the accounting period, and we talked a bit about this at the beginning, at the end of the accounting period, usually a month, could be longer, sometimes shorter, but that's typical, a month-long accounting period. At the end of that accounting period, the information from the general ledger is used to construct the financial statements. And you learned about these two. There are more than two, but these are the primary ones, and these are the ones you'll be dealing with in this course. The information somehow is put into the balance sheet and into the income statement. And then the final step is starting over, actually. At the beginning of the next accounting period, the cycle starts over. So this is what we call the accounting cycle. A transaction takes place, and the accountant or the bookkeeper records the transactions into the books of the business, the journal and the ledger, and we do some journalizing, we do some posting, and then at the end we put that information into these two financial statements. That's the accounting cycle. In this course, we're going to kind of work backwards. We're going to start with these two statements. You'll learn about the end result. We'll start with the end in mind here. And this is the information that you'll learn in topic 3, how to construct a balance sheet and an income statement. You've dealt a little bit with this already, but we'll spend more time with it. And then we'll go back and start at the beginning of the accounting cycle with the journal and the ledger and see where that information comes from. At this point, I'll ask you to go back to your course page.